All right, good morning, everyone. We're going to go ahead and get started. I call this meeting of the Municipal Audit Committee to order. We are noticed today, March 9th, 2023, from 11 a.m. to 12 noon at City Hall, room 155. There is another meeting right at 12 noon, so we are going to have to keep this meeting contained to the time period it's noticed. Let's go ahead and start with introductions, starting on this side, and we'll go around and then we'll go to the phone.
Scott Lee, Internal Audit.
Mike Chadwick, Internal Audit.
Suzanne LaFrance, Assembly.
Felix Rivera, Assembly.
Joy Mariner from BDO. Kelly Mays with BDO.
Grant Utricka, CFO.
Casey West, Acting Controller.
Thank you. I want to note for the record that Kent Colhase, Acting Municipal Manager, is excused. Let's go ahead and go to the phone. I believe we have two Assembly members on the phone, starting with Kevin Cross.
Yeah, present and walked.
Great, thank you. And then Robin Dern.
Yes, Robin Dern. Thank you.
Great, thanks. All right, so then we're going to go ahead and move on in our agenda. We don't have any unfinished business today, so we'll go to new business. We have 3 items of new business today. We're going to start with an update on the Municipality of Anchorage FY 2022 audit plan from BDO. So we'll go through that presentation. Then we will have a discussion around fund balance, and then last, a discussion around performance values results, PVRs. So we'll go ahead and start with BDO. I'll turn it over to you. And we have a presentation for folks on the phone. Is this, oh, wonderful. Just want to note for the record that Mr. Cross is in person. So for, I guess, Ms. Dern on the phone, is this presentation up on the committee website? Great. Wonderful.
Actually, I'm going to be there in a couple of minutes. So.
Okay, well then we will see you soon, Ms. Dern. All right, I'll go ahead and turn it over to Ms. Mariner.
Great. Thank you very much. Can you hear me okay? Okay. I have Kelly Mays with me as well. She's a senior manager who's the day-to-day boots on the ground for your engagement. So I had her come along too. So you had a chance to meet her, and just know that we work pretty closely. We're kind of just joking about how much we blow each other's teams messages up. So, anytime there's an issue, you can always bring it to either one of our attention and we let each other know about it. I think we talk a super number of times a day. I won't even want to admit how many. But my goal here really is just to remind you that we're starting the process for the 2022 audit. We do work for the audit committee. And so it's my goal that you feel that we are communicating well, that you have good information from the front end and all the way through the process about where we stand on the audit. And so this is our kind of, every year we kind of give you an audit plan. It's very generic. So let me touch on a couple of key highlights. But basically, as a reminder, we are responsible for forming an opinion on the financial statements. These are not our financial statements. They are your financial statements, and they are prepared by your management team. We also perform our audit for the federal and state compliance testing, which is called Uniform Guidance and State Single Audit. And this just kind of gives you the standards that we're following for those. And then there's another audit we perform called the Government Auditing Standards Audit. And really, government auditing standards are a more robust level of independence and skill level that we perform, as well as additional tests over your compliance with external laws and regulations. So we don't test a city code necessarily. We test, for example, that you're submitting your payroll taxes, or that you're following the arbitrage laws, or HIPAA compliance if it's significant. So areas as part of the audit that could get the municipality in trouble from an external regulatory perspective. In terms of our strategy, there's a lot that's on this page. This is, again, rather generic. We look at last year's results. We look at inherent risks. So when you have turnover in management, that's inherently a risk because you've got maybe processes or things that might have changed. And then we look at things that are happening generally within the industry. New accounting standards, and there is a new accounting standard this year. We're going to talk about that, leases. Your own significant policies and procedures, and anything that's considered an estimate. So where you've got numbers in here that are estimated, your biggest ones really are like the landfill closure estimate. You have your pension liability that's actually estimated at the state level. Your allowance for doubtful accounts. Are people going to pay their bills. And those are kind of estimates, depreciation, that aren't hard and fast dollars, but the statements inherently have some level of estimation in them. And we look more carefully at those if there's any incentive maybe for there to be bias in how those things are calculated. We also look at the control environment generally. Where there are issues with controls, we then supplement that with additional audit procedures. So if, for example, in your IT system, there aren't strong, robust segregation of duties, maybe one person has access to a lot of different areas in the IT system, we would then turn around and test more of the transactions that that person was a part of, just to kind of address the general risk. So that can take lots of different forms, where we've got, that's where kind of the turnover falls, where there's changes in the control environment or the approval process. We would maybe look at more robust documentation to the source document. Maybe we would send a confirmation where before we would have just, looked at an approved invoice. So that's kind of how our understanding of controls is how we develop our audit procedures. So those two things are very closely linked. Where controls maybe aren't as robust, we would test more. Where controls are more robust, like for payroll, your controls are very specific. They're very, well, Michael's nodding. they're painfully meticulous on some of the payroll controls, right? So then there's less testing we have to do to substantiate the payroll. And then we also look at materiality thresholds. My tolerance for errors in your statements is much smaller where something has, where you maybe have an incentive to change it, or if it's maybe more susceptible to fraud or error, my materiality level will go down. If it's something that is really just a classification concern, maybe materiality would be up. And then we have materiality for you. I just think it's important for you guys to remember, we actually audit multiple different levels of the municipality because we audit the water utility, the wastewater utility separately. They each have their own materiality levels. Then we also audit solid waste with its own materiality level, port, ACDA, the PAC, those are all at their own lower materiality level, civic as well. And then at the municipality level, anything that's a major fund is also got its own level of materiality. And then you have the kind of overall government-wide materiality. So the amount under which we care, I guess that's what materiality is, a number where we believe somebody would be misled if there was an error. That's the definition of materiality. We believe somebody would make a wrong decision. It's you, would make a wrong decision about your municipality's direction or approving something because you can't see that difference. So as long as that number is below materiality, we'd probably still tell you about it unless we consider it to be so minimal that it's not worth reporting. We would report it to you, but it's not something we would require be changed in the statements. So every year we'll come to you with adjusting journal entries. Those are things that were adjusted in the statements. So the statements have been corrected. And then also what we call past adjustments, which are things that are errors that are not corrected in the statements. So we'll report that to you at the end of the day, at the end of the audit.
Sure. Ms. LaFrance?
Thank you, Mr. Chair. And I heard you say that you look at other agency requirements like HIPAA. Would that also include OSHA?
To some degree. So, and even on HIPAA, we're not coming in to do a HIPAA compliance audit or an OSHA compliance audit. We do certain procedures, one, to make sure you have policies in what we consider to be direct and material financial statement areas. OSHA doesn't typically have a material financial statement impact. I mean, if you were egregiously out of compliance with OSHA, you might have a penalty or a fine. But historically, OSHA penalties, now there's some exceptions, especially if you're a hospital, but you're not. OSHA penalties do not usually rise to that large, something that would be for the municipality, wouldn't expect it to be in the millions of dollars. They might hit you with kind of a warning first and then, a $20,000 penalty. So OSHA, we would be limited to, do you have an OSHA policy if you need one? And then a legal inquiry. As usually with HIPAA, same thing. But for payroll taxes, if you don't pay your payroll taxes, the IRS gets kind of mad. Same thing with arbitrage. There's some big financial statement impacts to certain laws and regulations.
And just so I'm clear too, these are all issues and potential findings that could impact the credit rating of the municipality.
Yeah,
that
and
accurate?
the credit ratings are thankfully not something I have to audit. But credit ratings are determined by a lot of factors, but I would say the majority of the biggest factor for a credit rating is simply the financial position of the municipality at any given point in time. So, if your financial position is looking weaker, meaning your current ratio, your current assets are versus current liabilities are in jeopardy, or your fund balance numbers and your fund balance reserves aren't covered, then that's going to be a bigger factor for a credit rating than some non-compliance reporting. Non-compliance with laws and regulations gets very expensive, so it does have a financial statement impact, but the credit rating agencies are largely relying on the financial statements themselves.
Got it. Thank you so much. Thank you, Mr. Chair.
Okay, so I won't bore you with all of that, but basically there's a few things that we've identified as significant, not even significant risk, but our two significant risks are fraud risk, which we also call management override. Management override is when somebody were to override a system that's already in place. So I'm just going to pick on Grant because he's sitting next to me. Let's say Casey posted an entry. She, wanted it to go there, and Grant said, no, I don't want to do it that way. I have the power. I'm going to reverse your entry and post it where I want it to go. Now, Grant's never going to do that. I'm not sure he really ever wants to ever post a journal entry. He doesn't have access. Perfect. But so we would look at, for example, if he did have access, the entries that he would post. So management override is saying, hey, we have these great controls. Things are getting posted where they should get posted. What's being done to override that and do it differently? So that's in every audit, something we have to look at. And then for revenue recognition, just making sure things get put into the right period, that you're recognizing revenue at the right amount. So it's different depending on the revenue stream. For example, the utilities, we're looking at that billing revenue. Are they using the right rate? Solid waste, it would be, looking at the solid waste revenue. The muni, it's actually grants largely and some charges for services. So that's an area of significant audit risk. Items of note this year, this is the exciting stuff, GASB 87. I've been talking about it a while. I don't know, maybe 6 years? It's here, and it's here with a vengeance. So one advantage you have is that you're a December year end. So my June 30 clients, I don't think any of us, including myself, realized how big of a deal it would be. And so as soon as that kind of came out, I've been talking about it with the Muni for years, right? But as soon as we realized, holy smokes, the actual documentation for this is going to be big. We were on the phone with your team. They have a plan in place. The biggest thing right now is figuring out, I think you have a good inventory of all your leases. So that was a big project. It's been going on for years. But GASB 87 has a couple big things that we weren't sort of on the front end expecting. One is that potentially your management team is going to talk to you about it, but you may want to consider not presenting comparative statements for the component units and standalone funds. The reason for that is if you have a comparative statement, you actually have to implement back to the earliest period presented. So you have to go back 2 years. And this would be for AWU, solid waste, port, ACDA, PAC, and I'm missing one. Civic doesn't have any leases, so it doesn't matter for Civic. So that's something that sort of hit us sideways in the for-profit world. They gave an exemption. They said you don't have to do that. But GASB either was too lazy or really didn't want to give you that practical expedient. So on the GASB statements, on your statements, for those standalones that have both years presented, you may want to consider not doing that. And so just this morning, we had a call about it. Casey's going to look into the reporting requirements on that, make sure there's nothing wrong from a bond covenant or a loan covenant compliance or RCA requirement to present both years. It will save you a lot of money if you don't. So that's kind of an interesting thing. Also, your team's looking at what rate to use. This is a big estimate this year. So all of your leases are now being evaluated as basically a right of use asset. So you would record, say you're leasing a space, just an office space somewhere outside of Muni buildings. What's that? Oh, yeah, perfect. Yeah, exactly. Right. So you're leasing a space, you actually record a right of use asset and a liability to pay for it for the life of the lease. Even if there's an extension, assuming you're going to extend or you plan to extend or it's reasonably possible that you would extend, I think it's actually probable is the wording. Kelly's about to kick me for using possible, probable. Then you would record, let's say you have a 10-year lease with another 10-year option. It would be 20 years and you record a liability. It's a really weird standard. So your team has a fun time to try to figure out what discount rate, what interest rate to use for each one of the leases. And they're already evaluating that. I've made some recommendations on my end of how to work with public finance to use reasonable rates, not to make a whole lot of make work for yourself, to group leases together. So these types of leases are similar. These types of leases are all airport leases. We're going to do it all this way. So there's consistency and not a lot of management pain. Also, I encourage your team, and they're doing that, to use sort of a threshold, almost like you do for capital assets, where you're only capitalizing things over, say 5,000 or 25,000. Same thing for leases. Establish some sort of threshold so you're not dealing with those $1 State of Alaska leases that won't end, and really kind of establishing some parameters so you're not creating more work for your team than you need to. So GASB 87 is the exciting thing this year. There's some changes to personnel this year that will impact your controls. We're going to be looking at that. Debt and bond covenants, especially with bond rating change, making sure that you're not in any jeopardy from your bond covenant side of things. You did have a bond refunding this year, I believe, so we'll be testing that. This list is kind of long, sorry. FEMA just never seems to die. So hopefully it doesn't die until they're fully paying everything. So I guess it's good it's still on that list. MLMP balances are finally getting zeroed out. So there's a few kind of lingering things as you are closing out the final operations and accounts for MLMP. And then we always look at just your potential contingent liabilities this year, maybe even more particularly given some of the things, of course, every newspaper article that comes out, somebody sends it to me. So I have accumulated those to make sure there's no potential contingent liabilities, talking to your team about some of those. And then lastly, just compliance with federal and state procurement standards. Again, we don't test to city code, we test to federal and state external, but I know that there's been some questions about procurement as well. So that's my laundry list. Any other items? I'm happy to talk about any of these, but if there are any other items that you as the assembly would like us to look at as the audit committee, I'm happy to handle any of those as well.
So I do have a question. How do you calculate potential contingent liabilities? And what does contingent as a qualifier, what does that mean?
So excellent question. So there's an accounting standard that covers contingencies. And thankfully, I don't calculate anything. Your team calculates anything that they would consider to be a contingent liability. So that's in consultation with lawyers and just their understanding of potential items that are in question. So contingent liabilities may be an employment settlement or employee dispute or a former employee dispute. It could be a contractor payment that is in question or hasn't been paid. Sometimes that happens when you have kind of a contract that you've given and maybe they haven't done their work the right way. And so they are questioning the amount that you have to pay and you're holding money back, or you've paid them some, but you want some back, or it's gone to trial. It could be also related to violations or potential violations, accused violations of employment law, labor law, EEOC claims, employment opportunity claims, human rights violations, all of those things. So how do we test? So that's what it is. Your team evaluates what they have on their understanding of things. They do a calculation of any potential contingency and then work with the attorneys to determine an amount. So you record something if it's estimable, and it can be a range of loss. And you also record it if it's probable. If it's both of those, you have to record it. If it's not estimable, but it's probable, then you're supposed to estimate it. If it's really not estimable, then you just disclose it and you say, this is happening, it's probable, but we have no idea how much it will cost. And then if it's not probable, then it's typically just either a footnote. Just say, this is something that's out there. This is, they're wanting $250,000 in contract damages. The municipality is, contesting it and do not plan to pay it. Some of those get kind of generically applied. If you look at last year's statements, it says, as part of the normal course of business, the municipality is involved in certain litigation, So most of the items that come in your very long attorney letter get sort of grouped into that generic wording. It's anything that's usually over, I don't want to throw a number out there, but over a material number, for you, it's somewhere over 2 million or so that gets separately disclosed with a little bit more information. Depends on the statement you're talking about. If it's one of the standalone statements, the number might be a little lower. So like the Marad lawsuit, for example, that one was actually a contingent asset. So it's a little bit different, but any of those kind of contingent things, we're not really sure how it's going to turn out. And so for how do we test it? We send attorney letters. We send confirmations to the Human Rights Commission, to the EEOC, which is the Equal Employment Opportunity Commission, Department of Labor at the state of Alaska for workers' compensation claims or any sort of labor claims. And then we also review attorney invoices and, hopefully, usually we try to get the detailed statements that say what you were consulting your attorneys with. And then we also inquire with the internal Department of Law here at the Muni. That being said, we also would inquire with you. So if there's, certain things that you want to disclose to us either now or later, I'm happy to talk about those as well.
Great, thank you.
And this kind of is the generic answer to how we do that. Lots of different tests, basically. We're testing things, confirming things. Timeline is a little bit shifted, but not too much. This was actually revised about 3 weeks ago. We kind of took a look at where you stood. So we're actually starting most of our interim procedures on April 3rd. The biggest things you have kind of still in the works, I would say, are that GASB 87 project. And GASB 87 probably isn't going to be ready until June. Yeah, we don't know yet. So I think that's, the biggest kind of piece here, and I'll let your team speak to that. But we're really going to, one of the things that was a challenge last year is because of certain delays in getting information last year, we ended up having a lot of the work needed to get done in June and July, where we had front loaded our team and our schedule to April and May. So we didn't have a few of the members of our team that I would have liked to have in June and July because they had already rolled off of the Muni schedule and onto other things. So we were able to, get other folks in there and get that work done. But this time I just have the team through middle of August because we need that time, June, July, and August. I'm almost certain. You have a September 30th federal single audit compliance deadline. And we cannot actually release the single audit report without the financial statements. I would love to be able to just do the single audit. I think Jose's ready for that. But unfortunately, the financials have to come alongside it. There is a July 31 EMA reporting deadline for a draft of the financials. So I think that would be sort of the drop dead goal, is to have the draft done by the end of July, the audit done by the end of September. So any other comments on that from the administration? Okay.
Thanks. So is it correct? I know it's been years since we've had a normal audit timeline, but is it correct that this is still an abnormal timeline, meaning we would normally expect to get the complete single audit by June or July, but we're continuing to push it until September for a variety of different reasons? Is that accurate?
Yes, I feel that every year is a different reason. This year is largely a turnover and capacity challenge. There aren't external factors besides GASB 87 that are pushing this, where last year that COVID was doing that. The year before it was COVID too. So let's blame them for a couple of years there. There was one year where the state of Alaska pension information came out really late. There was one year where there was a couple other things. It seems like every year there's something we can kind of point to. This year, from a capacity perspective, we had built a timeline for a June 30 issuance, but it meant a lot of stuff was done by kind of end of January, end of February, and capacity-wise, that wasn't able to be achieved.
Thanks. So when you talk about capacity, are you talking about BDO capacity or municipality capacity, or both?
Municipality capacity.
Okay, thank you.
And we worked with the, I know one thing that maybe you're aware of, and we actually have to disclose anyway, that they are using some additional staffing contract accounts to try to help. And I think that's really a good thing. We talked to them about the people that they hired. We've already had a call with one of the folks that's jumping on board to help. And so, I think that's going to be a real difference maker for your team. I honestly don't think September was possible unless you brought in some additional help. So the big areas that are still kind of unknown are PERS, who, that's going to be a big project for somebody, and the draft of the financials themselves, and whether that is something that can be done by consultants, done internally, or even if somebody from BDO needs to come in and help. So we're here to help. I live here, I work here. I want to make sure Anchorage is in good shape. So, whatever we can do that we're allowed to do and still remain independent. Of course, with your permission. That perfect segue into being independent. I do want to be independent, so we don't get to make management decisions. I'm not determining your GASB 87 discount rates. Your team is, but we can assist where we are allowed. The big thing for me is that that I work for the audit committee. I work with management. Our goal is to issue an opinion on the financial statements that's accurate. And I'm always going to bring things to you that I'm aware of, just as factual. I am very careful, and please hold me accountable to not make any judgment statements about things. But, big thing for me is just to report accurately the information that we find as my role as a public accountant. So I'll be the engagement partner again. So you're stuck with me another year. Kelly's our assurance senior manager. George has been working for years on your single audit, so he's going to continue in that role. So your team's turning over, same team from BDO side this year, and we'll do our very best to support your team and get the financial information audited and released as quickly as possible. And I think our hope is to issue as many standalones as possible by the end of June. So it's just the ACFR waiting for issuance in that kind of third quarter timeframe. I have some extra things in here you can, peruse. Cyber risk is huge. It's actually, people don't realize that if you have a cybersecurity incident, it's considered an illegal act by the Muni, even if you're not the bad actor that did it. Because if there's any risk that HIPAA information, PII information was leaked. And we just so you're aware, we have clients all the time that have cybersecurity incidents that somebody's email got hacked. They got access to their entire email, and it had social security numbers or it had paycheck information on it. It is considered a violation of law. So if that happens, please involve a cybersecurity professional as immediately as possible, and make sure that you're aware of what the impact was to that. I have a couple slides on there. BDO has lots of things in here, just links for you if you want to look about our audit quality or ESG. And the new standards coming up. The big one for you is probably the subscription one. Which one's that? Why can't I see that? There it is. Statement 96, subscription-based IT, that's next year. And so if you have any subscription-based IT agreements, that'll end up being kind of like leases. You gotta have add those in. So work with your IT group, and maybe worth having one of the IT people in here over the next year to talk about how they plan to help get this, or how much of an impact they think this might have on your statements. Leases, there's more information on each one of these that nobody wants to talk about in the report. So any questions or further comments for me?
Thank you so much for walking us through that. Are there any questions from members? All right, I'm not seeing any. Well, thank you so much again. All right, so we're going to go ahead and move on to our next discussion, which is around fund balance. And yes, I actually would like BDO to stay up here because we're gonna start with you, and then we're gonna go to the CFO. So during the presentation of the ACFR, the Annual Comprehensive Financial Review last year, BDO and our CFO raised an issue with the fund balance policy. This issue has come up from time to time, fund balance in general, as the Assembly considers usage of fund balance for appropriations, and we are told that we can't use fund balance for one reason or another. But when the administration looks to use fund balance, there doesn't appear to be as much of an issue. That's the broader context, which we're not going to delve into here. I'd like to start this discussion in our committee by getting a refresher on the issues that were raised last year surrounding fund balance. I reviewed the BDO presentation from October, and there was a page number and note a number given. I think members should have printed copies of that. And I'm wondering, actually, Desiree, could we pull up that information really quick on the screens? Do you have the ability to do that? Okay. But it's for folks who have the ACFR, it's page 121 in the actual document. It's page 139 in the PDF. And it's note 15. So we're going to start. I'm going to have BDO just do a review and refresher of that note 15, which they did go over with us in October. And then the CFO has a presentation that we will go through as well. Before we begin, my goal for this discussion in this particular committee is to gain a better understanding of the issues at hand, see if there are any policy implications, and then start to dive into those if they do exist before handing this issue off to the full assembly via a work session or some other format. We might not be able to do all of that today, so this will likely be an item we discuss in this committee for a few meetings before we bring anything to the full body. With that, let's go ahead and start with BDO. If you can just walk us through note 15.
Sure. So maybe it's helpful to just start with a really high level context of what fund balance is. And I know that most of you have been really familiar with financial statements, so this may sound really boring, but at the very highest level, what fund balance represents is the equity that a fund has. If you take all the assets of the fund, and those are the things it owns, like cash or receivables, inventory, prepaids, those kinds of things. And you back out all the liabilities of the fund owes to other people. For example, the general fund owes payroll at the end of the year because there's a difference between when somebody works and when they get paid. So there's those accrued expenses, those kinds of things. So all we're doing is taking all the things that the fund owns minus everything the fund owes to other people. That's what's left over. If you owned a for-profit company, fund balance would be the equity that you own in your company. What's left over, that working, capital. And the governmental funds, it really does represent working capital in a sense. Another way to think about fund balance is it's an accumulation of all the, and we don't use these words in real governmental land, but profits and losses over time for that fund. So if you take all the ins of the fund from inception and all the outs of the fund from inception, this is what's left over, right? And at the end of 2021, that number was about 11 million bucks, 11.6 million in the general fund. And so there's a lot of things that change fund balance. Revenues coming in like property taxes would increase fund balance. Payments out for costs would decrease it. If you're transferring money from one fund to another fund, that would decrease it, right? If you're taking money from the general fund and funding something in another fund, maybe you want to fund something over in solid waste or in a special revenue fund as a match for a grant, for example, it's going to reduce fund balance. So your fund balance at the end of 21 was 11.6 million. At the end of 20, and that was on page 123, Desiree, if you can go to the bottom of 123. And that number represents, and that's not here, but it's about an $88 million reduction in fund balance from the prior year. They don't have comparative statements because we just talked about that. You don't have comparative statements, but this is just for this 1 year, it's about 11 million and it's a huge reduction. So last year I felt it was my responsibility, even though as an auditor, I just opine on the financial statements, but as a citizen and also from an auditor's perspective, we look at sustainability of a fund or of the government as a whole. And this is just something to watch out for. The number's still a positive number at the end of 2021, but I don't know what the number was at the end of June. And given the Sullivan Arena cost, the end of June when I was here, maybe I was even later in September, my understanding is that number had gone down even further. So my concern there is you have a fund balance policy. And if you go up a little bit more, maybe to the bottom of the previous page, Desiree, fund balance is made up of lots of different things. And this shows both the MOA trust and the general fund, all sorts of different things. But the general fund, there's some elements of the general fund you can't spend. So for example, the amount that you have in assets held for resale, it's not as if you can turn around and spend it. It's held up, right? It's held up in a kind of a longer term type of thing. The same thing with inventory. Your inventory is an inventory you're going to turn around. It's not like an iPad that you're an iPad salesman, right? It's inventory that's kind of stuck there. You can't convert it easily into usable cash. So the next category is restricted. Restricted is important, and that's at the top of the next page. Restricted fund balance is things that somebody external to you has restricted those use. So for example, there was some amount of the MLMP proceeds you had to hold until, I think till CEA had reconciled out some of the receivable balances. There's some MLMP types of things. And then if you want to say, go for it.
Just offering, if I can clarify that. Yeah, can you speak to me? And if we could be brief, please.
It's not a whole lot of money, but like there's external reasons why things might be restricted.
Good morning, Ben Bowman, Assistant Municipal Attorney through the chair. The unspent MLMP sales proceeds have been set aside for professional services to wrap up and close out the sale of MLMP. Right now, there are some professional services to meet a requirement within the purchase agreement that we have a draft of the potential purchase agreements, which might be used under the current power purchase agreements. But those are agreements that would be used 30 years from now at the end of the power purchase agreements. And we're still working through the process of resolving those. And there's also the accounting costs for accounting out the residual MLMP. So that's the $600,000. That's there for.
So that, is about 2 million in total that's restricted by external sources. So that one's restricted by the purchase agreement with MLMP, with Chugach, and some special levies. So between that's $21 million. And then the next section is committed. Committed are things that the assembly has taken action to say, we want a 10% bond rating set aside. So the assembly has said, hey, in order to make our bond rating, we want at least this dollar amount to be in fund balance. It's not accessible for other things. And that number is 50 million at the end of 2021. Now, technically speaking, you don't have 50 million there, okay? Because your total amount is 11 million of fund balance. We've already said there were 19 million in non-spendable and 2 million in restricted. So you should have 21 million that you have actually to work around. So you can't also have another 50 million because you're already below the restricted and the non-spendable. So actually, that was one of the things that we went back and forth on the statements about. I don't know if you remember that case. You're like, can you even commit something that isn't there? I don't know. And so it was determined that this was a better presentation to show the committed and then to show a deficit. So you as an assembly have said, we want $50 million set aside so we can make our bond rating. And you've worked with your public finance division to say, if we have that 50 million there, then we're going to have the right bond rating, right? But you don't. You also have this working capital reserve. Working capital is pretty important. This is how you pay your bills and how you pay your employees. And you weather the time differences between when you get paid for your taxes and when you pay out your bills. And so this is kind of what you as I don't actually know where the working capital reserve came through policy, I believe, that basically you just say, we need at least $11 million to work with here, right? This is our cash flow. We need $11 million in order to weather those time periods when we don't get all our taxes yet and we got to pay these bills, right towards the end of when the property taxes are right before the property taxes get sent out, the bills get sent out or they're due. So there's always that kind of lowest point in the year. You never want your reserve to be under 11. Right now, you don't even have enough in fund balance for that reserve. And you don't have enough to cover your non-spendable, and restricted. So I would say in order to be a functioning government, you would need the 19 plus the 2, that's 21, plus the 11 for working capital, 32, 22, 20, 32. That's 32 million, right? So it's 19 million for the non-spendable, 2 million for restricted, and a working capital reserve. That's not even counting anything to meet your bond covenant. And you're at 11. So that's where I wanted to bring this to your attention. There's reasons for it. I think the majority one is that, FEMA didn't come into funding the Sullivan Arena costs. And so Sullivan Arena costs were adding up, right? And the expectation is that FEMA would cover those. I don't know what they have to date, but as of December 31, 2021, they had not covered those. And I know they have covered certain expenses since, but it was $88 million of a reduction in fund balance last year. And that number is not going to work long-term for sustainability of the municipality. So does that give the context you were looking for?
That does, yes. Before we go to the CFO for their presentation, do we have any questions for BDO? Yeah, go ahead.
Thank you, Mr. Chair. And not so much a question, I guess, as since that time, 90 million from FEMA has been obligated, leaving like 35 million, I believe, that hasn't been obligated yet, but the track record has been really good. And so there is reason to believe if it won't be fully obligated, it'll be close. And so I know that this is from the end of 2021 and very much appreciate you bringing this up. It's really important and really helpful. And I expect then we won't have a revised view. And of course, there have been additional expenditures in that time too, but we won't have a revised view until September then. Okay. Okay, great. Thanks. Thank you, Mr. Chair.
Great. Go ahead, Ms. Stern.
Thank you, Mr. Chair. I have a question about the 10% bond rating and the 2% working capital reserve. Are those industry standard numbers, percentages that you're applying here, or are those like historically derived numbers based on what we are using in this particular municipality?
I actually don't know why those numbers were chosen. Maybe somebody here does, but I would say they're not out of line with what we see other governments setting aside for bond ratings and for working capital reserves. Actually, working capital, a lot of people are doing a little bit more like 3 months of expenditures, I would say, is kind of a good benchmark as a working capital reserve. But most of those governments that are doing kind of 3 to 6 months of expenditures are probably adding the two of them together. So if you look at your total expenditures in the general fund, and I'm only talking about core expenditures, not those kind of additional things that you do, core expenditures in the general fund, your reserve number that I kind of say reserves are should be between 3 and 6 months to be financially healthy. Some of our governments are 2 years. Right. So I think that's where, your team needs 3 months of expenditures. And we certainly saw that with COVID. Suddenly you did actually need 3 months of reserves because there were, I think it came pretty quickly, the federal assistance, but we definitely saw some complete fallout of ed tax revenue, complete fallout of sales tax revenue, not here, but other places. And even some concern about providing relief for citizens to pay their property taxes that summer, right? And so there are a lot of those kinds of things to consider when you're setting that threshold. But I would almost look at them in a combined manner than looking at one versus the other.
So the fund balance policy, which is actually in the presentation that I have prepared, is, I think, from a AR in 2015. What I'm hearing anecdotally by other municipalities throughout the country, the 12% that we have is a little bit low. A lot of other ones have higher reserve policies.
Thank you. All right. I don't see any other questions. Thanks so much for that overview. Hopefully that helps provide some context for our next presentation. Go ahead.
So thank you, Mr. Chair. Reading the emails prior to this, I knew you wanted to talk about in the red flags, which I know we've addressed a little bit in Joy's presentation. I went a little step further where we're going to give a little background on fund balance and then look at where we are very preliminarily at 2022 to look at where we are. So Joy stole a lot of my thunder already, but well, it wasn't your fault. I think it was the chairperson's fault. But so I'm Grant Utrinka, the CFO. The presentation, the input from it was by a lot of people, primarily from the controller division and public finance that have done great work. This is where we're at. We'll start out with a fund balance background. We'll go into the 2022 activities and then have a little conclusion and discussion. And I know we're pressed for time a little bit. So the background, as Joy said, fund balance is basically the equity in a private business. It's the assets minus the liabilities with some nuances with deferred inflows and outflows. The unassigned fund balance, which Joy spoke to a little bit, is kind of what's left over after the non-spendable, the restricted, the committed, and the assigned fund balance. AR 2015-84, which is approved on March 24th, 2015, set the limits of the 10% and the 2%, 2 to 3%. So that's what's guiding the fund balance policy. We have talked about some best practices, and we may want to look at revising that fund balance policy sometime in the future to bring into kind of where we are now of recovery when you're below the policy, which we don't have. So again, these were on some of the things that were on the screen before. Overall fund balance, you can see the total of the $623 million, pretty strong. And obviously the biggest part is the MOA trust. The 11.6 is what Joy talked about in the general. And then she talked about the 88 million deficit that we had last year, which was on page 32 of the ACFR. Any questions there? So, and then again, the breakdown of where we are, which we just went through these numbers before, so I won't spend any time unless there's questions on it, but it's right out of the ACFR, pages 123 and 124, which we had on the screen. Here's some historical data. Other than the year, the left-hand column has the net changes that we've had year to year in fund balance. And you can see how it's been up and down over the years. And then the big one, the 88 million in 2021, which contributed to the unassigned other of 71 and the total unassigned of $60 million deficit. But you can see the changes from year to year. Then moving into 2022 activities, kind of my disclaimer is 2022 is unaudited. Not all periods are closed. Even some actions that the Assembly took on Tuesday night will affect 2022 actuals. So these numbers are going to change. They're very, very preliminary. We ran a trial balance for all the general funds. Then we included COVID revenues and expenses. We included certain revenues and expenses that were in programs from 2021 that were inappropriate, and so we're moving them back into the 2021. And we added some revenues that we've talked about not yet posted. So thoughts to methodology, do you understand what we're doing? We're taking all the transactions and kind of comparing them to make sure we've got everything in there. So we preliminarily, it looks like we did significantly better than we did in 2021, but not as much as I think any of us would hope that we would. There was a lot of good news in 2022. We exceeded the SEMT revenues by over $6 million. The bed tax came in higher than anticipated. Of course, the MOA trust put out $17 million to the general fund. Labor costs due to staffing and other reasons were under budget. Interest rates rose an unprecedented amount last year in a number of increases, which affected our cash pool earnings or losses. They're invested pretty conservatively, but when the interest rates go up, the value of the bonds held in that pool often dropped. And so the general fund lost about a seven-figure amount in the fund balance earnings, or in this case, losses. We had inflation, as you're aware. We increased the shore side contract recently because of the changes in fuel prices, and that affected a lot of other things. And then we're still exploring how some of the entries were done for things like the solid waste services building at ARL, that FEMA has paid some money, obligated some money, and we've obviously had expenses. And we want to make sure we have all that, so that in an understandable format. And so we're trying to put together what's happened in years past to make sure we account for it properly this year. One thing that we've spoken to is the recognition of revenue. And this is what we get from the state when they obligate funds. You'll see kind of in the middle of the screen on the left-hand side, there's a date of January 2023, and this is a $9.3 million obligation for expenses that were incurred in 2021. Because of the way special revenue funds and that type of thing worked, and some of the findings last year, the 2021 expenses that weren't obligated, from FEMA were shown in the general fund. So this was a big contribution to that negative 88 million. Now, when we get new revenue, we can record that as revenue, and the expenses occurred in prior years. So it's a good thing. We knew we were going to get this money. In fact, we got about $10 million in obligated funds in January. We knew it was coming from all the dialogue that we'd had with the state and FEMA, but we cannot recognize this money in 2022 because the date of the letter is 2023. And that's not an administrative policy, that's a
FEMA policy.
So, you may recall that we've spent total roughly, and you get these from Alden's reports, about $126 million in total COVID expenses. As of the end of 2022, we had about 80 million in obligated funds. We've gotten another $20 million in funds obligated this year, but it's at the end of the year, it's still left a $46 million gap of unobligated money. Now, some of the good news is in the discussions we've been having, or Alden and others are having with FEMA and the state, we are looking hopeful, and it's looking better that even congregate sheltering through June of 2022 will be covered by FEMA. So very, very good news. But they haven't yet, so we can't recognize any of that revenue. So where we're going in so doing a comparative of 21 versus 22, you'll see the numbers in non-spendable, restricted, committed, roughly the same. And with the numbers we've run so far, we are looking at about an increase in the unassigned fund balance of about $10 million, but that takes us from the $60 million deficit to a $50 million deficit. And we come close to meeting the bond rating reserves with, again, disclaimer, preliminary numbers, but we don't come close on the working capital. Questions there? Conclusion, kind of where we're looking at adding a bottom line to the 2022, increasing that change of fund balance of $11 million, we're still looking at a $50 million total unassigned. As I just mentioned, FEMA has unobligated funds of about $46 million, which would leave us at a negative. If we're able to recognize all that revenue, it still puts us close to a $5 million negative fund balance. And as we've talked about before, or in other committees, there are things like the Building Safety Services Fund, which after this year will be showing close to a $15 million negative fund balance. And so until we start recovering those funds or other funds, we are not looking at a great picture going forward. And it is, I believe, by code or by charter, each of these obligations need to self-fund. And obviously, the Building Safety Services has been negative for many, many years. But as Joy had explained previously, that accumulates over the years, and it's not a year by year, accountability for it, if you will. So that concludes my presentation. If there's questions, I'm happy to discuss them. And I know, Mr. Chair, you had discussed something about the, certifying funds, for administrative projects, but not necessarily other projects. And some of that is due to code, where I've got one up here with lapsing funds. Section 13-07, where anything that's not encumbered will lapse into fund balance unless it's appropriated through a capital fund. So some of it is done by code and charter. And we probably don't have time to get into a lot of that today, but we can carry on those discussions later, because it's certainly, these numbers are math, and that's what we're trying to, come up with and be as apolitical with the figures as we can be.
Thank you. I appreciate that and appreciate you walking us through this. So we are pretty much out of our time, but if, and actually before I go to any very quick questions and quick responses, are there any members of the public here who would like to participate in audience participation? Okay, I'm not seeing any. Then we can go ahead and use our last couple minutes for any initial questions. As I stated, this is probably going to be a multi-meeting discussion. So this will be on our Municipal Audit Committee meeting agenda the next time we meet, as well as the PBR discussion, which we weren't able to get to today. Go ahead, Ms. LaFrance.
Thank you, Mr. Chair, and thank you, Grant, for the information. A follow-up request, would you be able to provide a spreadsheet that breaks out each upward pressure by line? Like, for example, I see there that the fund balance with FEMA unobligated has been added in, and then leaves a pro forma of 4.8 million. But I understand from what you went over that there are other drivers that are putting pressure on the fund balance. It would be helpful to know like what those amounts are.
Maybe we can talk
Okay.
offline, because I'm not quite following,
Sure.
but I think we can do what you want. It might not be a simple spreadsheet, but
Okay, sounds good. Thanks. Thank you, Mr. Chair.
Thank you. Any other comments before we adjourn? All right, not seeing any, then looking forward to continuing this discussion in the future. Thank you so much. All right, with that, this committee is adjourned.